IREN Ltd is currently trading at 55.39 per share, representing a significant intraday climb of 5.99% as of late morning trading on this Friday, January 23, 2026. While many retail participants are distracted by the broader volatility in the tech sector, what is happening under the hood of this specific ticker suggests a massive tug-of-war between institutional bears and a new breed of AI infrastructure bulls. The immediate development that most people are missing is the launch of the new trader short-leveraged exchange-traded funds that hit the market only yesterday. These funds are designed to give sophisticated traders a way to bet against IREN with double the inverse exposure. And yet, despite the arrival of a specialized tool to drive the price down, the stock is actually defying the gravity of those short positions and pushing toward the mid-50s. This creates a fascinating curiosity loop because it implies that the selling pressure which was supposed to crush the stock is instead acting as fuel for a potential squeeze as we approach the weekend. The common belief about IREN is that it is simply a Bitcoin miner that got lucky during a crypto bull run. Many people still view this company through the lens of a pure digital asset play, assuming that if the price of Bitcoin stumbles, this stock has to follow it into the dirt. But the reality is far more complex and arguably more stable than the market narrative suggests. We are looking at a company that is fundamentally changing its identity from a power-hungry miner into a high-performance computing powerhouse. The massive $9.7 billion contract with Microsoft that was confirmed late last year changed the math entirely. This is not just a story about mining coins anymore. It is about providing the literal physical foundation for the largest software companies on the planet to run their intelligence models. When you see a nearly 6% move today on heavy volume, you are seeing the market slowly realize that the old valuation models based on hash rates are becoming obsolete. Today's trading volume is already pacing well above the 20-day average, indicating that big institutions are repositioning themselves ahead of the February 5 earnings report. We are seeing a high level of aggressive buying coming into the bid every time the stock dips toward the $52 level. This suggests a strong floor is being established by buyers who are looking at the $3.4 billion annualized revenue target the company has set for its GPU fleet. The price action today is particularly telling because it comes on the heels of several analyst upgrades earlier in the week. Firms like Bernstein have started calling this a top pick for 2026, not because of where Bitcoin is going, but because of the 140,000 NVIDIA GPUs the company is on track to deploy. The tension here is palpable. You have shorts betting on a technical breakdown and bulls betting on a structural transformation. Let's talk about the short interest because this is where the real action is for retail investors right now. Currently, the short interest as a percentage of the float is sitting near 20%. To put that in perspective, anything over 10% is considered high, and 20% is a powder keg. There are roughly 54 million shares sold short, and with the current daily volume, it would take about a day and a half for those shorts to cover their positions if things turned against them. We are seeing borrow rates for the stock begin to tick upward, which means it's becoming more expensive for the bears to maintain their positions. When you see a 6% move on a Friday morning, it often forces short sellers to reconsider their exposure before the market closes for the weekend, as nobody wants to be caught in a gap up on Monday morning. Investors need to look at the institutional filings to see who is on the other side of this trade. Firms like Citadel and Susquehanna hold notable positions, but the activity in the options market suggests a lot of hedging is taking place. There are nearly 2 million contracts in open interest right now, with a heavy concentration in call options at the $60 and $65 strikes for the February expiration. This tells us that while some institutions are shorting the common stock, they are also buying out-of-the-money calls to protect themselves against a massive upside surprise. This kind of dual positioning often leads to extreme volatility because as the stock price rises, the market makers who sold those calls have to buy the underlying stock to stay delta neutral, which only adds more buy pressure to the tape. Comment below how many shares of IREN you currently hold, or if you are sitting on the sidelines waiting for the February earnings. It is also worth asking, do you think these new double inverse ETFs are a smart move for bears right now, or are they just creating more potential for a massive short squeeze?
Actionable insights for those monitoring the short side of this trade include watching the fails to deliver data, which should be updated soon. If we see a spike in fails to deliver alongside these rising borrow costs, it indicates that the liquidity for the stock is drying up. You should also be keeping a close eye on the intraday volume profile. If we see the stock hold above $54 through the final hour of trading today, it suggests that the bulls have successfully defended the breakout and that the shorts are feeling the heat. Interpretation of these signals is key. A spike in borrow costs usually precedes a sharp move in either direction because it indicates that the market is reaching a point of maximum tension. The retail sentiment on platforms like Reddit and X has been increasingly vocal about IREN. Many traders are pointing to the fact that the company is trading at a significant premium compared to traditional miners, but at a discount compared to dedicated AI data center plays like Equinix or Digital Realty. This middle ground valuation is exactly what the debates are focused on. Is IREN a cheap AI stock or an expensive crypto stock? The retail crowd seems to be leaning toward the former, especially given the vertical integration. Unlike many of its peers, this company owns the land, the power infrastructure, and the data centers. They aren't just renting space, they are the landlords of the digital age. This vertical integration is a major reason why their margins on the AI cloud segment are reportedly near 98% on a hardware profit basis. Looking at the business model, the transition is undeniable. In fiscal year 2025, they brought in a record $501 million in revenue, which was a massive jump of 168% over the prior year. More importantly, they turned a profit, showing a net income of nearly $87 million compared to a loss the year before. While the majority of that money still came from Bitcoin mining, the growth engine is now the AI cloud services. They are currently scaling their GPU fleet from 23,000 units up to that 140,000 unit goal by the end of this year. Each step they take toward that goal reduces their reliance on the volatile crypto market and increases their stable, recurring revenue from big tech clients. This is the fundamental shift that the shorts are betting against, but the data suggests the transition is already well underway. The older reports from late 2025 showed that the company was aggressive in its financing, raising billions through convertible notes and equity placements. While this did cause some dilution, the capital was used to buy the very hardware that is now generating high-margin revenue. It was a classic move of taking on short-term pain for long-term gain. The reality of their balance sheet now shows about $1.8 billion in cash and liquidity, which gives them a massive runway to complete their infrastructure build-out without needing to go back to the cookie jar anytime soon. This financial stability is a nightmare for short sellers, who usually look for companies with dwindling cash and high debt. In terms of the future outlook, all eyes are on February 5th. If the company can show that its AI cloud revenue is growing faster than the $7 million per quarter they previously reported, the stock could easily retest its 52-week highs. The catalyst will be the guidance for the second half of 2026. If management confirms they are on track for the $3.4 billion annualized revenue run rate, the valuation gap between them and traditional data centers will likely close rapidly. The risk, of course, is execution. Building out 200 megawatts of data centers at the Childress campus is a massive engineering task. Any delays in power connectivity or hardware delivery would give the bears exactly the opening they need to drive the price back down toward the $40 range. What is your take on the rising short interest in this name? Do you think the smart money is betting on a technical failure, or is this just manipulation trying to shake out retail before the big earnings speed? The debate online is split, but the price action today is leaning heavily in favor of the bulls.
To summarize the situation, the expectation was that IREN would struggle as the crypto market faced regulatory headwinds and the novelty of its AI pivot wore off. The reality, as evidenced by today's price of $55.39 and the massive Microsoft deal, is that this is becoming an institutional-grade infrastructure play. The launch of inverse ETFs has added a new layer of complexity, but so far the buying pressure is absorbing the short attacks. We have seen record revenue growth, a successful turnaround to profitability, and a clear path to becoming a multi-billion-dollar revenue generator in the AI space. As we move closer to the earnings date, the tension between the bearish narrative and the operational reality is going to reach a breaking point. Whether you are holding for the long haul or trading the daily swings, the data shows that the structural foundation of the company is stronger than it has ever been. This contrast between what the market believes and what the company is actually building is where the biggest opportunities usually hide. Would you like me to analyze the specific impact of the upcoming February 5th earnings on the options Greeks and potential price targets for the following week?